Hey, hello and welcome to our next instalment of the bi-monthly newsletter. For everyone here at Off-Piste Wealth, hope you had a lovely bank holiday weekend. Certainly enjoyed the recent coronation. So as always, the purpose of these short videos is to provide a synopsis of everything that's been going on in the financial news, as well as the overall markets. Today we had a significant update from the Bank of England in regards to interest rates, who decided to increase the rate of borrowing again by 0.25% or 25 basis points to 4.5%, which is its 12th successive rate hike and certainly the highest since 2008. This has been done in order to help curb the rate of inflation, which could stay higher for longer than previously expected. Back in the spring budget, we also had significant changes in the pension landscape, which I'll touch upon a bit later. And what I'll also be doing is talking about the world of banking, which has of course made recent news or recent headline news, and certainly not for good reasons. First of all, I thought it prevalent to talk about the pension industry first, as in the spring budget, the Chancellor Jeremy Hunt abolished the lifetime allowance charge, which is of course major news for people with significant pension savings. So what this basically meant was that the lifetime allowance charge, which was just over £1 million, what you would normally have to do if you were taking income or capital above that is pay a tax charge, and that is equivalent to 25% as taking income if you've got pension value above that amount, and there'll be a 55% tax charge if you're taking it as capital. This of course meant that many people would stop saving into pension once they got close to the limit. So what the government have done is completely abolished this limit, but the tax-free cash amount still applies to that £1 million threshold, just over £1 million. So actually the maximum amount of tax-free cash that anyone can earn is £2,680,275. So just bear that in mind. The annual allowance is also increasing from £40,000 to £60,000 this tax year. So individuals can now put more into their pension in order to obtain tax relief. And of course you can still utilise any unused annual allowance from the previous 3 tax years. Something called the money purchase annual allowance and also the tapered annual allowance is also increasing from £4,000 to £10,000. This will affect people earning above what was called the £240,000 tapered allowance. So for high earners, they would be disadvantaged by the amount they could put into a pension. That has now increased from £4,000 to £10,000. And also if you are taking income from a pension, the amount you can put into that pension therefore reduces, and again that's where the money purchase annual allowance comes in. So that can again increases to £10,000. The tapered annual allowance has also increased from £240,000 to £260,000, again from this tax year, again benefiting higher earners. Of course, if you want to speak to me more about what's going on in the pension industry, please do get in contact. Coming back to the interest rate decision that came out today, again, this has gone up to 4.5%. Many people were already expecting this, and of course markets were already seem to be pricing this in. And you know, this is off the back of high inflation figures that we've been seeing. Bank of England really do want to hit this 2% target by the end of 2025 if they can. We're yet to see if they continue to increase interest rates further than where they are. Of course, if they keep doing this, it might mean that we do actually end up going into a technical recession, which we are narrowly avoiding. The Fed and the European Central Bank, the ECB, also raised rates in line with these expectations. So the Fed raised rates by 0.25% or 25 basis points, with interest rates now to range of about 5 to 5.25%. It will now take into account overall tightening cycle, policy lags and other developments that determine further hikes. This has been factored into the level of inflation, which is now actually beaten forecasts but remains high at 4.9% over in the States. Powell did say that the guidance tweak represents a meaningful change, but also noted a decision on a June pause was not to be made in the meeting that they recently had, and added it was not possible to say with confidence if policy has reached a significant restrictive level. Coming closer to home, the ECB, the European Central Bank, raised its key interest rate by, again, 25 basis points following the US during its May meeting, signalling a slowing pace of policy tightening. Nevertheless, borrowing costs have now reached the highest level, similar to us, since July 2008, following 7 consecutive rate increases as the ECB strives to combat high inflation despite ongoing recession risks. Having said all that, the Eurozone does return to growth. The Eurozone economy returned to growth in the first 3 months of the year as output expanded by a minuscule 0.1%. But the figure undershot economists' expectations of stronger growth as stagnation in Germany, the region's largest economy, offset expectations elsewhere in the bloc. What about the banking crisis? Something that's been making major news recently. We've been seeing issues with Silicon Valley Bank, or SVB as it's known, and Credit Suisse. And that's led many to think history is almost repeating itself with the banking crisis of 2000 and 2008. Recently, the UK Treasury and central bank officials eventually brokered a deal with HSBC to buy the UK arm of Silicon Valley Bank for a nominal fee, following the collapse of SVB's California's parent when a disastrous investment strategy unravelled. Then, of course, we had the admission by Credit Suisse, which found that it had material weakness in its financial reporting standards, which, of course, mattered hugely to global markets. While it is far smaller in terms of its assets under management than it used to be before the global financial crisis, it's still one of Switzerland's largest lenders and a major European bank with significant roles in investments and some other financial instruments. However, even with this backdrop, it has to be said that the UK banking system is far better protected due to higher levels of regulation than what they originally had back in 2008 due to the new capital adequacy rules that came into effect. If you haven't done so, I would highly recommend watching either Margin Call or The Big Short. Reason being is I think that the cast and performances in both movies are fantastic. However, on a more serious note, considering the industry I work in, it's always good to be reminded of the past and what has caused these types of pandemics previously. If year to date was worrying enough, 2022 was a stark reminder that volatility is very much back on the table. Investors throwing kind of almost like a dart at the wall perhaps no longer works like it did when a poor 2018 was sandwiched between the double-digit returns of 2017 and 2019. So we really have to be more careful in terms of the investments and stocks that we pick moving forward. However, despite the noise with inflation, rate rises, banking bailouts, tightening lending, and of course, an ever-looming chance of us going into recession, the global outlook for growth is still overall at an acceptable level of 2 to 3%. So, it means to be said that despite the obvious threats, there are still opportunities for investors out there, which of course we will look to capitalise on. Global earning forecasts and current valuations suggest a strong recovery in 2024 and good outcome potential for stock pickers looking beyond the noise, as it were, in the overall financial news. So as always, if you would like to get in touch, please do so. All my contact details are in the email provided, and I wish you all the best moving forward. Thanks ever so much, and have a lovely day.